Whether you're an investor in individual stocks or index funds, there's one question that is very important to your investment success, and that is, what is the ideal weighting scheme for your portfolio? You basically have three options. The first and most common is market cap weight. Then you also have equal weight, which is promoted by a lot of people. And then third, you have something that you probably have never heard of, and that is the coffee can weight. And I'll tell you more about that in the rest of this video. Market cap weight is whenever you buy the stocks in the weighting that they make up the overall index. So for example, the S&P 500 index, if you have 500 stocks, the index will sum the total amount of market cap weighting, and then each individual stock will be weighted in proportion to its total. So for example, Apple makes up approximately 6.5% of the S&P 500's total market cap. So in the S&P 500 index, it would receive a 6.5% weighting. Conversely, a smaller company, let's say Fortinet, its market cap relative to the total S&P 500 might be more like 0.6%. So if you're an investor in the S&P 500, your results depend 10 times as much on Apple as they do on Fortinet. That's why a lot of people are proponents of the equal weight S&P 500 or other portfolios. And in the equal weight weighting methodology, each stock has an equal weight, which is why it's called equal weight. So if there are 500 stocks in the S&P 500, each one of those stocks would have a 0.2% weighting. So in that case, you would have the exact same weighting in both Apple and Fortinet. Last but not least, you have the coffee can weight. If you're not familiar with the coffee can portfolio, it's an investment mindset that I've adopted and I believe is the key to successful investing, and that is you buy things with an extremely long-term horizon and then you hold those for an extremely long period of time, letting the compounding of each asset take over, and you avoid making mistakes or incurring any transaction costs. So the coffee can methodology is a bit of a hybrid of the equal and market cap weighting. So in the coffee can weighting, what you do is you start with the equal weight methodology. So let's say the S&P 500, you would buy each at a 0.2% weighting. However, unlike the equal weight methodology, you would not trim back to an equal weight once a quarter, once every 6 months, or once a year. You would then allow each stock to go in whatever direction it's going to go. So for example, if a company would go up 100% relative to the rest of the index, then its weighting would be 0.4%. If it would go up another 100%, it would be 0.8 and then 1.6, etc. So in some ways, the coffee can weighting scheme acts like both the equal weight and the market cap weightings. So which of these three weighting schemes performs the best? Let's start out looking at the most common weighting scheme comparison, and that is equal weight relative to market cap weight. We can look at the historical performance of two different ETFs. One of them is RSP, which is here in this dark blue line. The other is SPY. SPY is the market cap weighted S&P 500. RSP is the equal weight. And you can see that over the long term, they've been very close, but the market cap weighting scheme has come out ahead, at least going back to 2004. The other thing to keep in mind is that the equal weight has historically had a little bit more downside volatility. As you can see in 2007, when the market peaked, the top to bottom drawdown for the equal weight portfolio was roughly 60% relative to the market cap weighting at roughly 55%. So if you have to choose between market cap weight and equal weight, I think market cap weight is superior. What it does is it simply allows you to minimize transaction costs, and it allows the winner positions to keep on winning. So for example, 20 years ago, Apple was a relatively small weight, but as it's continued to outperform the rest of the market and become a dominant business, its weighting in the index has naturally increased over time. So this gives you greater exposure to winning positions, which tends to benefit you over time. It also minimizes transaction costs as you're not buying and selling nearly as much. With the equal weight portfolio, it's constantly selling the winning positions and buying the losing positions, which works well if the market mean reverts, But as numerous studies show, the market tends to not mean revert, which is why I tend to prefer the market cap weighting. However, I think there's a weighting scheme even better than market cap weighting, and that is coffee can weighting. To illustrate, let's look at a study from Jeremy Siegel. He looked at the original S&P 500 index, bought in 1957, and never touched for decades. Compared that to the actual S&P 500, which has been constantly bought and sold, added and subtracted from over the last couple of decades. So his question was, what would have happened if you just bought the original S&P 500 in 1957 and then done nothing with that? And what he found was quite interesting. These were the compound annual returns from 1957 to 2003. He did 3 different methodologies. The only difference with these depends on how they handle spin-offs or mergers and acquisitions. In some cases, they reinvested the proceeds from the spin-offs into the original parent company. But that's not what I want to focus on too much here. What I want to look at here is this initial weighting. So what he did was look at the S&P 500 in 1957, and in the first situation, he value weighted it. So this is how the S&P 500 market cap weight would have done. So for example, in 1957, maybe ExxonMobil was a 5% weighting, so he would have bought Exxon at a 5% weighting, whereas the equal weighted portfolio, he would have bought Exxon at a 0.2%. In both cases, he didn't take any additional action, but essentially the equal weight would just add more money to these smaller positions in the S&P 500 and put less emphasis on the larger positions. But unlike the equal weighted S&P 500 that we see today, this portfolio did not sell the winning positions and add to the losing positions. It just let them drift, almost like a market cap weighted portfolio in subsequent years. And this is what I would call the coffee can style. It's a starting equal weight, but then market cap drifting portfolio. And he found that that return was the best over time. It generated a geometric return of 12.3% per year, which is about 1% better than the market cap weighting and about 1.5% better than the original S&P 500. So if this would hold for future periods, what it means is that you could simply buy the current S&P 500 in equal weights and then allow those positions to drift coffee can style over time, and that would likely result in market-beating performance. So I decided to put this strategy to the test. I did a backtest in Portfolio 123. If you're interested in doing your own backtesting, I'll put a link in the description down below. So here are my settings in Portfolio 123. It does not allow you to buy 500 stocks at a time. It only allows you to buy 100 at a time. So what I did was essentially buy each one of the market cap segments kind of in tranches. So I had 5 different backtested portfolios, 100 stocks each, and then I took the average result of those. So that would roughly approximate what would have done had I bought the original S&P 500 companies, only instead of starting in 1957, this time I started in 2005, and the results were fascinating. So these were all the purchases on June 1st of 2005. Each one of them bought at a 1% weighting and then just allowed to drift over time. This portfolio returned a compound total return of 820% compared with the market cap weighting S&P 500 of 605%. I also took a look at the maximum drawdown, which was 54% compared with 55.2% for the S&P, and then also the Sharpe ratio. The next tranche was the stocks 101 to 200 by market cap. Again, this would be as of July 2005. These stocks returned 559% roughly compared with 605. So this segment underperformed the original S&P 500. The next segment returned 604, which is basically exactly on the S&P 500. Then we have numbers 300 to 400 by market cap. Again, these underperformed, 532 compared with 605. And then finally, we had the smallest 100 companies in 2005. And you'll notice that this portfolio did extremely well, and that was because one of the portfolio positions was NVIDIA. NVIDIA was one of the 100 smallest market cap stocks in the S&P 500 in 2005. So buying a 0.2% weighted position in NVIDIA would have resulted in that stock making up 53%. But remember, these are going to be divided by 5 since we're just buying 1/5 chunks of each one of these portfolios. So in the actual index, this would have grown to 10.6% had you bought a 0.2% position in 2005, just allowed that to continue to compound. That would be your weighting in NVIDIA today in this overall portfolio. So here are the returns of each one of those subset portfolios. We would have had a 20% weighting in each one of these. So if we just simply take the average, we can come up with this right here, which would have been the overall performance for this portfolio had we bought all 500 stocks in the S&P at 0.2% back in 2005. That would have resulted in a compound total return of 727.5%. And that compares extremely favorably with the S&P 500 market cap weighted, which was up 605, and then the equal weight portfolio at 516. You had a little bit of a larger drawdown from 07 to 09. This portfolio down 56.7% compared with 55 for the S&P 500. But this portfolio did outperform the equal weight. That was down 61% top to bottom. And then Sharpe ratio, you had exactly the same Sharpe for both the coffee can weighting and the market cap weight S&P, with equal weight coming in at 0.5. So if you're choosing between the market cap and equal weighted S&P 500, I think the evidence is pretty clear that the market cap weighting is superior. However, if you are managing a portfolio of individual stocks, I think the best way to go is to buy an equal weighted position at the beginning and then allowing the winning positions to continue to become a larger and larger weight, while the losing positions continue to become a smaller and smaller weight. Both Siegel and my studies found that this was the optimal weighting scheme. If you're interested in building your own coffee can portfolio of individual stocks, you should check out the Coffee Can Investing Club over on Patreon. You can access that at patreon.com/Nathan Winkelpleck. You can get a couple of courses, and also I publish my S&P 500 coffee can scorecards. That gives you access to some of my favorite metrics for assessing quality businesses. I publish that to subscribers once a month. Thanks for watching, and I will see you in the next video.